Excellent operating performance totally ignored by the market. Borrowings and governance issues occupy the center stage. A strange story of UPL Limited. Among the top 5 global leaders, manufacturing agrochemicals, industrial chemicals, chemical intermediates and specialty chemicals, UPL Limited is well known for its crop protection solutions and was known as United Phosphorus Limited up until 2013. Of the revenue, 40% comes from Latin America, which leads. North America constitutes 17%. Europe comes third, closely following Latin America. India comes next. And the balance comes from rest of world. In terms of growth, 20% for Latin America and impressive 25% for North America. Suffers in Europe. India maintains good growth. Rest of world joins Europe for reasons of geopolitical and related development. UPL had a very successful open market buyback started on 7th April and ended on 20th May. Issue size over rupees 1,100 crores. Ceiling price 875, closer to recent high of 841 on 13th January. Impressive response as the price was attractive and there was a rush to sell the shares in the market. UPL succeeded in buying over 1.34 crore shares at an average price of rupees 814. The net outflow was rupees 1094 crores plus tax. To the surprise of the company, the anticlimax was a sharp correction during the 30 days following the buyback, when the share price fell over 25%. And even the subsequent recovery maintains the discount at a rate higher than 10%. That is a matter of concern for the company. Something unique about UPL is its inorganic growth involving multiple acquisitions. Its largest acquisition was in FY19 when it invested over 29,000 crores. As a major global player, UPL's profits come from India to the extent of 1/3. Balance comes from overseas profits. Even on investment of net worth, India contributes 21%, while almost 80% comes from overseas. Overseas presence dominating both in assets and profits. The structuring of UPL has done more harm than good. Within India, it has hardly about 15 entities, but overseas, the number of entities involved are beyond 250, which is a nightmare from the corporate governance angle. More particularly, when more than 2/3 of the company's business and net worth is exposed and spread over the subsidiaries, and the complex web creates more problems than adding any value to the strength of the group. Sadly, over last 5 years, UPL has been subject to multiple whistleblower claims suggesting attempts to siphon off funds. The company has come out with reports and studies, but still governance worries persist and valuations continue to get impaired for unjust reasons. The company's performance over last 5 years, quite impressive, with a rising trajectory of profits starting March 2017 to the latest Q2 of FY23, yielding an impressive CAGR of over 21%. But market has been quite harsh on the company. For the corresponding period, market has granted a growth of a meager 7.7%. And even on the PE multiple front, it has been a descending channel for over 4 years. And PE reaching 10.9 has been punished with a negative CAGR of 10%. That's about the way market has perceived the company, ignored its growth, as there is ample amount of trust deficit as for the corporate governance of the company. UPL has been suffering both long-term and short-term funding issues. Inventories have been building up. Comparing March 20 to September 22, it has more than doubled, and as a percentage of revenue, inventories which were 22% in March 20 are close to 40% in the recent quarter. Buildup of current assets, more particularly abnormal increase in inventory, has been hurting the company. As for equity and external funding, short term and long term, the proportion of non-equity has been going up from 45,000 crores in March 19 to almost 60,000 crores in the recent quarter, and the share of external funding in the total assets is close to 2/3, leaving only the balance 1/3 to be funded by equity, implying higher cost of external funds. Mounting finance costs have impacted the company. Of the rising EBITDA, finance costs are taking away a major part. During September 20, the percentage share was 23.8 of EBITDA, and the rising finance costs have taken it to 30.3% in the recent 12 months. Even as a percentage of revenue, the finance cost has been rising year after year. September 20 TTM, it was 5%, and it has risen by almost 2% to 6.8% in the recent 12 months. Excessive interest burden and abnormal amount of exchange fluctuations have hurt the company. Company has benefited from its operating leverage, where the revenue has grown on a consistent basis, giving a 3-year CAGR of 20%. Its profit after tax has been quite impressive, with a CAGR of over 50% on a 3-year basis, and a growing trajectory in PAT percentage, moving from 4.6 3 years ago to 9.7 in September quarter, trailing 12 months. And a similar improvement is observed with a consistent increase in EBITDA percentage, moving up from 18.2%, reaching a high of 22.5 in the recent 12 months. Very strong and impressive indices of growth. To the credit of UPL is its success at growing geographical spread and market share, and nurturing its margins, effectively using operating leverage and passing on input inflation in terms of price escalation. The company has remained proactive, and it has recently proposed a strategic realignment, creating 4 distinct verticals within the consolidated entity: India Agritech, Global Crop Protection, Global Seeds, and Specialty Chemicals with the rest of the manufacturing, with the major shareholding with it and the balance going to the marquee investors ADIA, TPG, Brookfield and KKR. The proposed business restructuring is likely to get a funds inflow of over 2,150 crores from the marquee investors, and at the same time substantial value unlocking is expected from each of the proposed 4 business segments. Something special about shareholding pattern is promoters hold 29%, but the holding of insurance, mutual fund and a bigger partner FPI is almost double the promoters, and that makes it quite interesting. In the meanwhile, promoters have given a revised enhanced FY23 guidance, but the market response is quite lukewarm, as it appears not fully convinced. Hope you found this presentation on UPL interesting and useful. I am Vittal Prabhu with the weekly video on Stock Learning Simplified. You can access similar videos at our info card on Stock Learning Simplified. We look forward to your likes, shares and comments. If you are new to the channel, may please subscribe and press the bell icon for timely intimation on our forthcoming videos. Thank you so much for your valuable time and kind support. This video is for purposes of information, education and awareness only. This is not meant to be a solicitation or recommendation to buy, sell or hold securities. Wherever applicable, please seek the advice of a competent professional before taking action of any kind.